RBI has been concerned about conduct issues of all lenders.
They never surprise you. They will tell you. They will advise you what is right and what is wrong.
There is an effort to make the bank lending to NBFC more systematic.
We never generalize and say that, I'm not going to lend to this particular sector.
Draft guidelines which was issued by RBI was quite useful.
Welcome all of you. First is the preliminary remarks. We'll start. Tata will join us and all. So tell us this Reserve Bank of India action. You have nothing to do. That does not show the NBFCs in a very good light. I will start with you, Piramal thing and all. So are you concerned about the image of the segment, or you think no, you don't care, you're very different? Just preliminary remark to start with.
Yeah, sure. Thanks for having us. See, the RBI actions over the last year and a half have cut across both banking and non-banking entities. If you recall, the first set of actions happened with HDFC Bank. You have seen actions, with Kotak Bank. You have seen actions with a lot of other banks. If you look at the RBI website at the total number of fines and punitive actions taken. Here comes Rajiv.
Yeah, Rajiv, please.
इसके लिए ज़्यादा ताली नहीं बजाएंगे.
Yes,
Rajiv, आप late
आए. Again, he is one of the upper layer NBFCs. As I said, it's again 1 trillion plus 1.29 trillion as of January. That's the asset base. Which I just introduced the NBFC segment, and just the first round, the latest RBI action season disease order and all. So it's an image issue. I thought that, wow, how you gentlemen and the lady react to that. I mean, you said, no, we don't
Rajiv,
care, we are very
different. What I
different.
saying was that the RBI actions, sort of punitive actions over the last year and a little bit, have encompassed both banks and non-banks. It's the most recent round of action, which is 2 NBFCs and 2 MFI entities that has happened. So recency effect is kind of a little bit more in our minds. So, but in general, RBI has been concerned about conduct issues of all lenders over the last year and a half, and very appropriately so. I do think that the lending industry overall needs to take heed on the underlying concerns that are being raised on conduct, whether it is on interest rate regime, or it is on transparency to customers, or KYC. The main themes that RBI has talked about over this last year and a half. It's very important for us to take that into account. But in general, it is structure agnostic. The RBI actions have been structure agnostic.
Very, very democratic. Yeah, Rajiv, just do you think this image is now being tarnished, and you are concerned about that, or you think no, you are very different and you don't care? What is it? Just very simply, just preliminary remarks.
My thing is we should divide everything into two parts. One is regulations, which come as circulars or things which apply to everyone. And those are based on where they feel structurally anything is a challenge for the industry, and that needs to be corrected, for which they issue circulars or, the notices which come out. The other is, which is purely based on supervision, which is specific to individual entities and may not apply to all the entities. If it is specific to certain entities, I think we should take it that way, whether it is to NBFCs, whether it is to banks, or whether it is to small finance banks, or it is to MFIs. It needs to be treated in that manner that they have found certain challenges on those entities. They've asked those entities to make those corrections, and if those corrections have not happened in the requisite time frame given, that is when they take action. What I have seen with RBI is they never surprise you. They will tell you, they will advise you what is right and what is wrong. And if within the time frame that action does not happen, that is when it leads to this.
Yeah, Umesh, do you see, like, to extend the same thing, do you see that banks' approach to NBFC segment has changed because of that, finding it's not as easy as to get bank financing, or the pricing going up? Because many of them are talking about that, not of your size, but the banks are pretty wary of giving money to NBFCs at this point of time. There are many, the proposals have already been sanctioned, but disbursement not happening, or they're asking for 50 bips more kind of as it strained the relationship with banks, banks are a little, suspicious about NBFCs at this point of time, because at the end of the day, your money comes from the banks. Huh?
Yeah, NBFCs by and large are dependent on a bank for raising resources. There has been some kind of what you call relooking into the way banks are lending. There are new products or new arrangements have been coming, like co-lending is one of the arrangement. Because RBI also is trying to make it more of a responsible lending by making the NBFC also be a partner in each of the loan. So I think there is an effort to make the bank lending to NBFC more systematic, rather than having some ad hoc arrangements with some of the NBFCs. And the most of the RBI's concern on the NBFCs recently have been towards protecting the customer's interest, because over leveraging, borrowing more than what they are capable of, their income sources is, those are the things RBI has been highlighting. And that's where RBI has taken action. It is not exactly the NBFC sector has been viewed. So even the banks also have understood this language, and maybe even where they had arrangement with some of the fintech companies and all, they have moderated their lending to such arrangements. So overall, I think I don't see any of the banks trying to back off from the whatever the existing arrangement is.
Okay, Vishaka, you spend most of your career with a bank, and now on the other side, not necessarily other side, but NBFCs depend on banks for the money. So do you see for this kind of RBI perception about the sector changes the relationship between NBFCs and banks? Are they becoming more cautious, or pricing going up?
So first
Not
of
for
all-
you I'm talking
Yeah.
about, for the industry I said.
So to be frank,
Just
Tamal, I think what Rajiv says is right. We should not generalize the action of Reserve Bank of India. It is an entity specific, because they carry the supervision every year. Wherever there are concerns, they probably would have taken this action. Again, it's not that these actions were not done before. Probably the form and the method in which it was communicated was different. Most of the time it used to be the financial penalty, right? Most of the time it used to be one-on-one advice to the individual entities. I think now, because of the transparency and really, as Mr. Ravankar said, protecting the interest of the customer, they want it to be the way it has been enacted. Talking specifically about bankers' reaction to these, I don't think so. This is the first time that we are seeing it. I think as a banker who have worked in the banking sector for more than 30 years, I can say that whenever we do a lending, we never generalize and say that, I'm not going to lend to this particular sector. What we say is, yes, we are cautious about this sector, not necessarily because of the reasons that has been cited in the recent actions, but because of various other reasons. And then one looks at the specific companies, do a thorough due diligence, and then decide the limits. So I wouldn't say and generalize it to say that the bankers will take a view that they will not lend it to all NBFCs. It will be, NBFC specific. Probably the due diligence will be slightly more than what they would have done for the smaller NBFCs.
Sure. Vivek, you are very different from others because you're a state-owned and you are a Navaratna company. So give us a sense that, do you think that is not an existential crisis per se, but image has taken a beating for the sector? Is that right way of thinking?
I don't think the image has not taken a beating actually. The recent guidelines or advice issued by RBI has forced all the banks and non-banking finance companies to go for introspection actually, for taking self-corrective action. Since RSA into this infrastructure financing, let me cover one particular issue that RBI had issued in the month of May, draft guidelines for infrastructure financing. If the under construction project, if they are delayed, they have to make higher provisioning. In fact, the spirit is good that we need to have closer monitoring of the infrastructure projects. We do have the history of time overrun, cost overrun of these projects. The draft guidelines which was issued by RBI was quite useful, but it was merely draft guidelines. They are yet to come up with the final guidelines. And these guidelines apply uniformly to the banks as well as to non-banking finance company.
Yeah, I'm coming to that infrastructure financing, coming to that later. But let's just go to the central theme of this, the coming out of the shadows of this. Say one way of saying that you are, you are very integral part, essential part of financial system. Customers cannot do without you. You are a substitute for banks for many of them and all. That's other. And other way of saying is this: no, people are saying that no, it's not actually makes sense to be an NBFC because the arbitrage opportunity between banks and NBFCs are moving away. At some point, banks had reserve requirements you don't have, but now you see the LCR even applicable to you and all. One of the reasons was the HDFC got merged with HDFC Bank is this. Mr. Parekh said that there is no more advantage of being an NBFC altogether. So each of you, not you because you have a very different profile, I have a different question for you. Do you see this merit in that being an NBFC, the kind of advantages you have don't exist anymore? Or no, you think it's business as usual? Rajiv, starting with you.
So I don't think so any business model can be built on the arbitrage theory. It never was built. I don't think so if NBFCs have survived or have done well, then it is because of arbitrage. And if somebody says so, I would like that person to tell me which arbitrage. Where is the arbitrage? Today, are NBFCs doing well? If the answer is yes, and you say there is no arbitrage, how are they doing well? That is because they have a model which works well. Second, I can give you examples where in the same business, banks have an arbitrage over NBFCs. I think we should not use the word arbitrage in that manner. There will be places where banks will have advantage. They are far more regulated. They are bigger in size, but again, there I will differentiate a little bit. And NBFCs have their own model. I quite agree with what Vishaka said that you should not compare. You will have a lot of NBFCs which are much larger, governed far better than a lot of small banks. So putting all of them in one category is not right. Saying if some NBFCs face a problem, it is not the existential crisis for NBFCs. We have seen some banks face problem and some banks were merged and some banks face problem. That doesn't mean banking sector is in a problem. I think the way the system works is everything has to be looked at on its own merit and not decided by painting the whole sector in one way. That is my learning for last 30 years of being present in this industry.
Yeah, you are also banker turned into NBFCs. Vishaka, I go to you. That the advantages that the NBFCs were enjoying till recently, there is a soft touch regulation, it's no more there. RBI is very, very, vigilant about that. So it's as good as banks. The advantages you had in terms of reserve requirement, etc. That's also in a different prism now you need to see because LCR is applicable to you like to banks and all. So the perception is this: the advantages are no more there. It's better to become a bank, not to run NBFCs. Are you a taker of that logic, or you think no, it's good enough? The model itself is good, and you can be with them, and you can fill in the space which you require.
So, we are a very large country, okay, with a large population of close to 130 crores now. In order to serve the financial requirements of the whole population, I think we require a different models, right? And each model, as rather than saying arbitrage, has its strengths and certain weaknesses. Banks, of course, because of the obvious reason, had the ability to participate into the checking account and therefore, traditionally had the advantage of a lower cost. That no longer is true, right? Barring the top 3 or 4 banks, if you look at, many of us sitting on this DAS today, our cost is equal to the fourth or a fifth bank. So I don't think so that, necessarily you need to convert into a bank in order to take advantage or, so-called survival. I really think that
So because you have far less capex, you don't have to have branches, you don't have SLR, you don't have CRR.
No,
right?
so as you said, LCR we also have now.
Yes.
If you take the bank's cost of funds, add to it SLR, CRR, it will be equal to many of the NBFCs in the market
Yes.
in terms of size and scale. But, there will be various other advantages that they will have. The models that Rajiv spoke about, every NBFC has worked and therefore, the cost models will be very different. So you need to look at it on a holistic basis. And I really believe that conversion into bank may not be always the, the only solution for somebody to thrive and do profitable business. And also, I don't think so that the guidelines are out today. Right? We need to look at when the guidelines are out to see that, really evaluate it on the cost and benefit basis, and also looking at the opportunity, take a very balanced approach. I must say that, Tamal, you will remember as ICICI Limited, when we got converted into bank, yes, first few years we had to really struggle to get the deposit franchise established. So it does take, there are various other examples of people who have got converted into a bank and still struggling to get the model right. So I think one has to evaluate it. In a country like India, all models are important, and each one of us will have to find our niche and really look at the cost benefit to see how we can really service our customer at a very affordable price.
Umesh, do you have any different point of view or the same? You are the largest among us at this point of time, 2.25 trillion book.
Now, what I would like to say is most of the NBFCs, when they started with one purpose. Take an example, larger example of HDFC Limited. Till they made the housing finance as a big industry, banks were not lending to housing as freely. And now every bank is doing, and they're trying to be better than the HDFC. Of course, now HDFC is merged. Now look at Muthoot or the gold finance company, or look at a vehicle finance company. We all specialized. We have a niche. We have understanding of the market. So even though there are 9,000 NBFCs, if you look at each NBFC have a different business model. Nobody is same. Unlike banks, most of the banks look same. All their products look same. But all the NBFCs, if you look at, they are different. They have different niche segment. They are geographically closer to the customer, and they service a particular set of customers. So everyone has a choice. Now on-tap banking license is available. So anyone can choose to become a bank if they want to become. So unless there is a guideline or glide path for changing into bank, I don't think there is necessary to look at that NBFC to become a bank.
Jairam?
So a couple of thoughts I would say. One is there is a product level segmentation that exists in the market, and different competitors might open up different product categories. So historically, NBFCs in India have been the vanguards of innovation. Right? NBFC started the gold loans business. NBFC started the housing finance business, the car loans business, the microfinance business. Each of these businesses were started as NBFCs, eventually became banking businesses, right? But NBFCs have been vanguards for innovation. Role NBFCs continue to play, and I think that will continue to happen. The other point Vishakha made is also an important one, which is that along the risk-reward spectrum, different business models exist. Some players will play in a very low risk, low reward segment, but it will be very large in size. Other players will want to play in a smaller market, but which is higher risk, higher return, right? The same player cannot do both. It requires a very different mental model, very different DNA to do both those things. So different business models will exist and will thrive. However, will 9,350 NBFCs exist to serve 25% of the market, where 35 banks together form the other 75% of the market? That question is a worthwhile question to ask. Saying yes, all this diversification and all is important, different people serving different segments is important, but do you need 9,000 players to serve 25% of the market? That long tail has been troubling the regulator for a bit now, And every so often, you see this big culling that happens. A few thousand NBFCs disappear, right? Last time this happened when we were 13,000 NBFCs. There was a time when we used to have 13,000 NBFCs. And that 13,000 came down to 9,000. And it has been stable at 9,000 for a few years now. It is not out of the question that this 9,000 will come down to maybe 3,000-4,000, right? Or, by a different culling process. But that still means that there'll be many more NBFCs than there are banks serving that 25% of the market, which is not being served by the banks today.
Yeah, even if you say the number is 9,325, but actual operating, you will find that less than 1,000 NBFCs accounting for 95% for the
Correct.
entire assets.
And if you look at greater than 500 crores, you'll find 300 NBFCs.
Correct. Absolutely.
So it's a much smaller number than that number generally looks like. But from a regulator's perspective, the overhead exists.
Absolutely.
Those 9,000 names exist. Any of them could suddenly become important out of nowhere and cause systemic problems.
Absolutely. Vivek, coming back to you, because they are in a completely different kettle of fish and you are different. And you yourself raised about the infrastructure financing, the RBI's draft guideline. That draft guideline came up for very strong criticism. Nobody liked it. I mean, the banks, the NBFCs, nobody liked it. RBI governor is not here. So can you tell us, those who do not know, maybe you give us this example. I don't want to repeat that the higher capital requirement, that was the preliminary issue. And everybody found that it's pretty harsh. The business cannot run on that, if RBI insists on that. RBI is keeping quiet. No, work is on. We are all waiting, and there's a perception in the market that there will be some dilution in that segment. So just can you take us through? Just presume we don't know the background. Because you are into that segment.
Yeah. Let me share with you, for the benefit of the audience, those who may not be aware that RBI had issued draft guidelines in the month of May, stipulating that over next 3 years, the provisioning has to be made higher for those under construction projects which are delayed. Those banks or non-banking finance companies which were not following India's accounting standard, their profitability would get affected. But those who are already following India's norm, like REC has already been following India's accounting standard, our profitability is not going to be affected, but we'll have to make higher provisioning over a period of next 3 years, which may go up to 5%. Ultimately, it will lead to higher cost of lending for the borrowers.
Exactly.
That was the main concern.
Yeah, it will push up the cost of funding. Even NAFED, which is the government agency, as good as it came out of the budget announcement, also has the same opinion. True. So what's going to happen there? Tell us.
So we have given our comments to RBI, and we have also taken up the matter with Department of Financial Services. We hope that a balanced view would be taken by RBI, and they'll come up with the final guidelines.
So if the existing the draft guideline gets converted into final guideline, then the cost for infrastructure financing will go up.
Yes,
right?
that's true.
That's the way.
Yeah. That is the real concern.
Yeah. Okay. Tell us, Jayaraman, because you are very different. The gentleman next to you is suited and with tie, everything. you are very different. You always in t-shirt wherever you are. And when it comes to products, also your entity is very different. So tell us, what is the way forward? We have a bank-dominated system, and of course, at this point of time, we are talking about the high CD ratio. Corporations should go to market to access money. Little different kind of structural changes are happening. So what would be the future of NBFCs at this particular moment?
So Tamal, the high CD ratio problem is today much lower than what it was 3 months ago.
Yes,
In
yes,
3 months,
it's
this conversation will
slowly.
go away.
Yeah.
That conversation will not be part of the regular charter at all, without anybody taking
And
any
none
specific
of
action.
you are in the business of taking public deposits.
Yeah, so that
Sriram, you are there.
Sriram
I'll come to that. Yeah.
So,
Yeah.
but the CD ratio question doesn't apply
Yes,
to
no,
anybody
yes,
here.
no, absolutely
Right?
no.
And in general, in the banking sector, deposit growth rate and credit growth rates are now equalized. In fact, credit growth rate is lower than deposit growth rate on the most recent fortnight's data. So, and CD ratio is down at whatever now, 78, 79%. I think in 3 months, this whole conversation about CD ratio will go away. I think we will not be talking about it anymore. I think that systemic problem is that crunch that we felt systemically for the last 6-8 months, that crunch is over. I think we are past the tightest part of that crunch. Now, going forwards, it is clear that the regulator is indicating that these interdependencies between banking and NBFC sectors need to be made less, right? Essentially, it needs to be loosely coupled. The sectors need to be loosely coupled rather than tightly coupled with each other so that contagion from one doesn't pass on to the other. Like that's the general thought, which means that NBFCs need to find different sources of borrowing.
Exactly, that's what I was coming
Right.
for.
So you have to, if banks today are, let's say 55-60% of NBFC borrowing, that might need to come down to, let's say 40%. But then where will the delta 20%, like where will it come from? Either domestic capital markets or international capital markets.
ECB route is drying
Exactly.
up. In the sense, when do you think they were, I mean, I can't remember when somebody raised substantial money to
So the two
ECB.
of us are sitting here. We have been raising a lot of money internationally. Sir has been raising money every few months. He raises in the international market a lot of money. I think, see, international markets are open. International markets are extremely deep. They are not cheap.
This is what
Right,
I'm
they are
coming
not cheap.
for. Even
So
after adjusting for rupee
you
depreciation.
just have to, like, if you want to go to the international market today and diversify yourself, you have to be ready to pay an additional price. Now, this doesn't happen at all times in the cycle. There are times in the cycle when international markets are cheaper
Yes.
than India markets.
Not now.
As it happens today, they
Yeah.
are more expensive
Yes.
than domestic. But through the cycle, you will find either international markets or domestic, or Sir talked about co-lending as a model, as a different way of actually, raising capital, co-lending or securitization as a different way of raising capital. Different things need to be done. NBFCs need to get creative. The liability stack of NBFCs 3 years from now might look different from what it looks like today if RBI continues the pressure on banks to not lend as much to NBFCs. The liability stack will look different. And depending on where it goes, your cost of borrowing might also look a little bit different. That your business models need to be resilient to take care of that.
When you say different, what does it mean?
Means today,
Now it's 60% bank, right?
exactly. So that might need to go down,
Yeah.
let's say to 40%, right? And that remaining 20 could either be more international borrowings, more domestic market-led borrowings, bonds, or securitization, or any of these other routes that are common internationally in lending institutions, not as common in India, but you'll probably see that happen.
Rajiv, are you seeing that because of RBI pressure on banks?
No, I think you will see this again. See, clubbing everything together is never the right way. Like when we give out credit, when we lend to every different companies, whether I'm lending in the steel sector or in automobiles, we don't look at the whole sector as one. We look at each company separately. Similarly, when you are looking at, anybody is looking at an NBFC, also they have to understand that. For example, for us, bank borrowings are lesser than 40%.
Okay.
Not even 40, I'm saying they are lesser than 40%. We borrowed a lot of money in ECBs, and ECB is much cheaper than bank borrowing.
Even now?
Much cheaper. I'm not talking about little cheaper, much cheaper than borrowing. We intend to go out and borrow through bonds because it is a good time. But Jairam is right. Things change. There are times when bank money is cheaper than foreign money. There are times when foreign money may be cheaper than bank money. A private NCD is even cheaper today. So it varies. I think what all of us will always do, will have access to all of these and push the pedal on that which gives you a lower cost so that you optimize your cost. That is what every lender does. That is what we do also. So I think here also what we will see over a period of time, and you were mentioning earlier, see what has happened is, has the bank money become costlier? It has become costlier because banks are borrowing at a higher rate today compared to what they were borrowing earlier. Their term deposit percentage has increased on their overall liability. RBI has increased the risk weightage on lending to NBFCs, so automatically they have to price all of this in. So the moment you price, the cost of plus liquidity has not been as easily available, so cost has gone up. In terms of availability of money from banks, I think that has not changed. At least we have not seen a change in that front. So that's the way I look at it. The proportion will change, but the proportion will change because you will always be present in all the segments and you will choose to press the pedal of that segment which gives you a lower cost. But despite that, a good strategy is always being present in all segments because you don't know how nobody has been able to predict interest rates in each segment, and neither can we.
Umesh, yours is the only entity which is in the public, I mean, raising money from public and all. So what's your experience now? How much money, what kind of interest you are offering, and is it easy as easy as it was in the past, or you're finding it difficult?
Umeshji, if with your permission, if I may make one small interruption, and I'll
Sure.
and hopefully you'll come back. There is an important distinction that needs to be drawn, and just in case people are a little bit confused
Yep.
about whether international borrowing is cheaper or more expensive, because I'm saying it's more expensive, Rajiv is saying it's cheaper, you're like, what's happening?
No, it is more expensive.
I want to make a distinction between borrowing in international bond market versus borrowing in ECB loan market, right?
Sure.
They are two different things. ECB loan market today is much cheaper.
Yep.
The international bond market is a lot more expensive. ECB loan market is open to fewer people. It's more work to get ECBs done. So big names like Tata's can easily get
Yeah.
ECB loans done. For people like us, it's a little bit harder to get it done. So when we think of international, we think of the bond market,
Yeah,
which is more
absolutely.
expensive.
Because
Sorry, Umesh ji, back.
US bond yield is higher, and then plus you have the
Hedging cost.
forex cost, also the hedging cost
Hedging cost,
at this point of time. Yes, please.
Yeah, see, we are a deposit-taking NBFC, and we can take up to 1.5 times of net worth.
Yes.
You can't go beyond that. So, for us, we are growing at around 20% year on year on deposits. So, maybe we are having a good time, I should say, and that's a good growth rate. On the interest rate part of it, we are offering around 8.5 to 8.6, on par with some of the smaller banks, or maybe sometimes we are lesser than smaller banks. So to the extent,
Yeah.
we have been reasonably, we are there in this business for nearly 46 years. So that's where you build reputation, goodwill, and you are able to raise resources comfortably. But we are not just dependent, as earlier speaker have been telling, both Jayaraman and Rajiv. We have always planned our liability equally among everything. Like banks, we are at 25%. We have a securitization of 15%. We have a capital market around 20%. ECB of 15% and deposit 25%. So we have been there in everything. We need to be very clear that there is no permanent source of resources at a particular rate. It keeps varying, and how keep on observing it and keep being there is very important. We also raise both ECB loan and ECB bond, both we do. So that's fairly distributed sources. We should be there to be there in the market throughout.
You want to add anything? Or we can ask after this, just anybody has any question, can you just get the microphone ready? Very brief, if anybody wants to have any. Yeah, Vishaka.
I think most of the points are covered. I would say that I think a lot of steps have been taken by SEBI also recently to create a vibrant bond market. You know, one of the things which they recently announced is the liquidity window facility, right? The biggest problem for the bond is there is no enough liquidity, and therefore people prefer to invest into more liquid securities and bank anytime you can withdraw money.
The secondary
Now,
market you are talking
that's
about.
right.
Yeah?
So there is no secondary market, and therefore there is no liquidity.
Yeah.
What they have said is that you can come, and we have worked with them very closely to say that the best person who can offer that liquidity, because when you come to the bank, any customer can walk into the branch today and say that I want my deposit back. Now, that facility, if it is made available with the NBFCs, then, you know, the NBFC bond becomes equal to a bank. And they have actually said that the 10% of the liquidity facility can be offered by the issuer themselves.
Absolutely.
Now,
Absolutely,
what
yes.
we need to do as an NBFC is, yes, you know, our life becomes a little difficult. We need to manage our liquidity much better because that 10%, you know, anybody can come and demand that money from us. But according to the law, even Companies Act permits the companies to buy their own debt. So it is possible. They made it, you know, now possible. We'll need to utilize it. And of course, we are committed to say that how do we diversify our liability? It's not about NBFC or anything. I think it's important for the growth of the company that you do not rely or you do not concentrate your liability in one source. And I think it is in the right direction. There are various other steps which are being taken. I think the warming up of the international investors. I cannot imagine, you know, the international investors coming and putting large money into the Indian market. But today, you know, you find that people are investing. Look at mutual funds. Today, mutual funds are almost 70 trillion, and they are investing. 65% of their AUM today is equity, but 35% is debt. So there is a question of time when they will start investing into many of this paper. And I think directionally, what has happened in the developed market will happen in India, which means that the people who will gather liabilities need not be necessarily the people who will originate the asset. Because each one of us have the model, you know, which is very unique, and therefore there could be an NBFC which can generate the, you know, the assets at a very reasonable cost, who can then give it to, you know, somebody who has liability and can then hold this asset to the maturity. So I think we are moving in that direction. We need to continuously evaluate and test the various sources of liabilities, and that is what we are committed to do as an industry.
What about REC on the money front? I mean, the liquidity front. What is your way? Anything? Any challenge you are seeing at this point of time?
Let me tell you that after becoming a Maharatna company in September 2022, our asset under management has been growing at the rate of 17% from 3,85,000 crore. Now it has increased to about 5,46,000 crore. And our disbursement have increased from 97,000 crore to 1,60,000 crore in the current financial year.
You are larger than PFC, right?
Yeah, now loan size has become larger than PFC.
Yes.
So what we do, the bottom line is that how to keep our cost of fund minimal. We keep a diversified portfolio of our borrowing mix. Like we have got, being a government NBFC, we have the advantage that we can raise 54 EC bond, that is capital gains tax saving instrument. About 40,000 crore we have raised through that. That is the cheapest source of fund available to us. Then corporate bond. About 40% of our borrowing comes from the corporate domestic bond, and bank term loans, domestic term loan constitute about 18% of our borrowing. As Jairam has rightly pointed that ECB bank loan have become cheaper. So we have increased our external commercial borrowing from 24% to about 30%. And we have been using innovative hedging techniques, particularly for the ECB bonds also. We are trying to keep our borrowing below 7%. And we have been able to bring down by the end of Q2, quarter two, we have brought down our cost of funds about 7.05%.
Okay. Anybody has any question? Otherwise, we'll go to the last round. Yeah. Okay. Yeah. Just quickly, can you get? Yeah. Yeah. So this please, this lady. Yeah. Quickly. Yeah.
Good evening,
Just
sir.
Introduce yourself. And
I'm
just
Namita
quickly.
Mohanka from Millennium Mams, a non-profit organization which promotes financial literacy for women. So my question to Mr. Sabharwal is that, across sectors we see the big becoming bigger. And I believe that this is also going to play out in the NBFC sector. So what are your thoughts around this?
I don't think
Thank
so.
you.
This is true in the financial services industry. We are seeing so many new companies coming in. Look at the number of new NBFCs kicking off business. Look at the number of new HFCs. There is enough of private equity and venture capital money chasing. Today I was talking to a couple of PE people, and that still NBFCs, HFCs are on top of their agenda. But there is an advantage of having scale. That scale allows for more operating leverage. It allows for your ability to diversify your borrowings. But I don't think so in this business, in any way, we are seeing smaller companies, lesser smaller companies. We are seeing, in fact, with the success of large NBFCs, we are seeing more smaller companies coming into the NBFC and the HFC sector.
Thank you. This gentleman, please. Please introduce yourself and brief question.
Hi, my name is Jayesh Shah. My question is, what's the end game of NBFC? Is it going to be banks? Now, this is a debate which may go on, but in terms of direction and RBI regulation, do you see that end game being playing out, or you think RBI is happy to give independence to NBFC and continue to see them grow the way they are?
Whoever wants to take it, Vishaka or Jairam, you want to?
यार end game तो बहुत ही dire सा phrase हो गया. There is no end game.
Thank you.
We've been we've been NBFCs for decades. We will continue to be. The individual companies might decide to actually move their business model to being banks, etc. if they want to. But the model of borrowing from the markets and actually lending to individuals is not a model that's going away anytime soon. So I think I would stay away from there is no sunset of the sector that's going to happen.
Thank you. Yeah, this lady, yeah, please.
Yeah, so good evening. I'm Dimple Khetan from Arat Capital. My question is to Jairam. So you mentioned that it's a bit difficult for you to raise funds through ECBs as compared to Tata and all that. So what are the factors which makes difficult for you? Is it credit rating or some other factors?
Thank you. Yeah, please, Jairam.
Yeah, see, in general, when you're trying to raise a loan, the number of years in business matters a lot. So, storied names which have been around for decades in the financial services business. Umesh sir and his company has been around for 4.5 decades. He will find it a lot easier to actually raise money in that market. Somebody who's been in business for 5, 7 years, 10 years like us is going to find it a little bit harder because you just don't have the same name recognition. So ratings are one thing. Of course, ratings matter. They are an important element. But beyond international ratings, I mean, domestic ratings don't matter at all. International ratings matter. But beyond that, a lot of soft factors matter. Governance, name recognition in the history, all that stuff matters.
Thank you. This last one, yeah. Then we'll get back for one-liner for the last
Hello.
one. Yeah, please.
I'm Samir Agarwal from Neve Credit Limited. We are also in small NBFC and student loan. Just want to have a quick question. As madam, you said that India is a large market and banks and NBFCs both has to survive to cater to the entire population. I just want to touch upon a subject about co-lending, which RBI prescribed and most of the banks and NBFCs are doing, but we have not seen much of traction happening there. Any thoughts or how can that be utilized to make sure that both banks and NBFCs work together and actually reach out to the larger population? And what are the fundamental problems we are facing on that? Anyone can take.
Vishaka, you want to answer?
No, so I think there is no problem in the model per se. We also work with few banks. We also work with the smaller NBFC. Somehow operationalizing it is a bit tougher, right? Because you have to disburse, parallelly. You need to do a joint, appraisal and so on and so forth. So I think it is more operationalizing. I've seen it from the bank side. I've seen it now from NBFC side. So I think it's more operational. I don't think a model per se has an issue.
Thank you. Just gentlemen, quickly, we're running out of time. Yeah,
Hello.
just take, yeah, please.
My name is Sandesh Bhangre. Sir, last year we same problem has happened, we noted. This year we same problem happened, we noted. Next year we same problem happened, we noted. We not solving any problems. Financial.
That's a comment, not a question. So just this gentleman, please, quickly, last one. Sorry, you have run out of time, so No comment, just a question. Introduce yourself. Yeah, thank you. Please.
Yeah, hello.
Yeah.
Very difficult to get this mic. Yeah, I'm Sunil Mehta here. I just wanted to know, in order to lower the cost of funds for NBFC or in general, whether any one of you have raised ECB in rupee.
ECB in rupee. Yep.
We had the masala bond which came in rupee. If we start initially, that there was some advantage.
Thank you.
But after that, that product did not really develop much. So we moved to ECB after that.
Thank you. So just we have, thank you. Just we're running out of time. Just one liner from each of you. You know, NBFC serves a very important purpose. It's an integral part of Indian financial system. I mean, there could be a pressure point, there could be issues and all, but it's not, there may not be 9,000 odd NBFCs, but NBFCs will be there. And NBFCs are known for innovations, right? Most of the products, I'm not fabricating anything you guys only said, I'm just rephrasing it, this, whether it's a gold loan or whether it's an auto loan or whether it's a home loan, these all came from NBFCs. And later banks, like for instance now, Catholic Syrian Bank has close to 50% gold loan in his book. One bank, close to 50% of his book only gold loan. State Bank of India has the biggest gold loan portfolio. So that your USP actually goes away, right? So each of you, can you tell us that, and you are very large NBFCs, you will remain. You have already your USP because in the financial sector, you are in the power finance. But each of you, can you tell us that 4 years, 5 years down the line, there could be something the banks are not doing, but we'll find out some kind of thing from NBFCs in terms of product innovation I'm talking about. Like gold loan, auto loan, vehicle loan, mortgage, everything came from NBFCs and the bank started later. So is there any possibility anywhere that
the unpopular answer, I'll give an unpopular answer right now is tech-based lending. Tech lending has come from the NBFC sector and has become so big and has had its own problems and is having kind of credit and blowout issues, etc. But eventually, pure tech-driven lending is going to be a big part of lending business in India, and it would have started from this sector. NBFCs would have created.
Rajiv, want to add anything, say anything? Anybody? But that's not a product. You're talking about tech-based lending, right?
Yeah, but
Are you talking?
BNPL, for example.
BNPL, buy now, pay later. Yeah. But most of the problems which RBI is very unhappy is this in the loan apps.
Go through its teething issues, just like it happened in the microfinance sector to begin with. When the sector got started, initially there were a lot of teething issues, lots of interventions happened, cleanups happened, etc. Over time, the sector matures, and then you have banks taking over 60% or 40% of that market, and banks like whatever,
Okay.
Thanks. So that type of thing
Jairam,
will happen here.
You started, Rajiv, you got enough time to think.
No, I think innovation will continue to happen. Both NBFCs will innovate, banks will innovate. Banks have more access to information than NBFCs. So innovation will happen on products, innovation will happen on processes. It will continue to happen. Nothing specific for me to point out.
Okay, sir, please.
See,
quickly,
one line. Even in a country like US, there are 20% of the people who have no bank access or bank credit access. So in India, it is 80% of the people who don't have a bank credit access. So there's a very long way to go before bank reaches to everyone.
Vishaka, you want to add anything?
See, I think an innovation will happen on the customer segment as well as geographical. I think still, if we really believe in India's story is a Bharat story, right? So as Mr. Revankar is saying, I mean, 80% of our population is unbanked today. So there is a huge innovation, processes, products, etc., which can happen in a different customer segment and geographies, according to me.
Last word from you.
As country aspires to become a developed country by the year 2047, I do feel that banks and NBFCs are not the competitors, but they are critical partners in the development story which is going to
Absolutely.
happen.
It's a story of collaboration, it's a story of cohabitation. So thank you all. We have had a long day. If you have enjoyed, just give them a big hand.